What are the relevant assertions for cash? Now, a relevant assertion is one that has a meaningful bearing upon whether or not that account, in this case cash, is properly stated. There are some assertions that are normally not relevant, such as valuation. The only time that you would normally see valuation as relevant assertion is when you have foreign currencies. And normally we don't have that. So I'm going to give you 5 assertions that I think can be relevant in cash, and those are existence, completeness, rights, accuracy, and cutoff. Now I'm going to narrow down the 5 to just 3, so let's bring this down even more, because the 3 that I think are usually the most important, that are really relevant, are existence, accuracy, and cutoff. Now, why would I say existence is a relevant assertion? For all asset accounts, there's a directional risk that they are overstated. Now, why is this? If a client wants to make their balance sheet look healthier than it really is, they'll overstate certain asset accounts, and one of those could be cash. So, since there's a directional risk, a risk of fraud, that the client might overstate cash, that then existence becomes a relevant assertion. So when you audit cash, you simply want to make sure that those accounts are really accounts of the client, that they really exist as you audit cash. Now, the second one I mentioned was accuracy. So how do you normally audit cash? I can tell you, I haven't been out on your audits, but what we always do is get that bank reconciliation, and then we tie that bank balance back to a confirmation or to a bank statement. We add the deposits in transit, we subtract the outstanding checks, and we come down to our balance per the general ledger. If a client is committing theft or fraud, if they're stealing money, sometimes they'll alter the bank reconciliation to cover up the theft. And I saw this happen several years ago. The person that was handling that bank reconciliation just added a loan and just called it unreconciled difference. And this person had stolen $300,000, and she was playing with the bank reconciliation to cover up the theft that she had committed. So you want to make sure the bank reconciliation is accurate. So we want to tick and tie those numbers to the subsequent month's bank statement. We also want to add those numbers and make sure they really do come down to the ending balance. So accuracy is a relevant assertion. And the third one I mentioned is cutoff. Now, similar to playing with the bank reconciliation, the client can inflate the cash account by allowing certain receipts to be recorded in the current period that really belong to the next period. So we want to make sure the client cuts off the transactions at the end of the period. Now, I mentioned 5 different assertions as we started this video. There were 2 more, rights and completeness. And in regard to rights, we just want to make sure the client really owns that bank account. And we can do that by sending a bank confirmation. But, here we are doing the risk assessment, and we want to think about what are the potential problem areas, and one problem area would be that a client is showing a bank account as though they own the account, and they really don't. So rights can come into play. I would say of the five, this is the least risky most of the time. But when it's in play, it's really in play. And then the fifth one is completeness. Now, this one might confuse you a little bit. And it used to confuse me when I would see people list existence and completeness as relevant assertions for cash. And I'm thinking, wait a minute. Existence has to do with overstatement of cash, and completeness would have to do with understatement of cash. These seem to conflict, and they really do. But there's two different things we're considering here. With existence, we're concerned that they're intentionally overstating cash, overstating that asset to make their balance sheet look better than it is. With completeness, it's a different issue. It's the issue of potential theft. So let me give you an example. I was auditing the hospital once. There was a bank account where Medicaid payments were being paid from the state electronically to this Medicaid bank account, and the CFO had the signature rights on this Medicaid bank account. Well, he was writing checks to himself to the tune of about $2 million. Well, those transactions never appeared on the general ledger because he never set up the bank account on the general ledger. And so cash was not complete. So sometimes you'll have clients that would desire to steal money, and they do steal money, and the way they hide it from the auditor is they don't put the cash account on the general ledger. So in that type of situation, completeness can become a relevant assertion. That's unusual. So it's probably less important. That completeness assertion to me is less important than the existence assertion, but it can come into play. And you do want to make sure that the client has all of their cash accounts in the general ledger, and most importantly, that the cash line in the financial statement is complete. So the five important or relevant assertions for cash are, can you tell me what they are? Do you remember what we said? They are existence, completeness, say this with me, completeness, existence, accuracy, rights, and cutoff. So if you pay attention to those areas as you do your risk assessment, you want to think about how these five assertions are important in properly stating cash. And then as you do your risk assessment procedures, you can focus on those areas that are really important. And then you can disregard those areas such as valuation that normally are not important or normally not relevant. So those are the assertions in cash that are normally relevant. Now again, this always changes from client to client. I'm just giving you a general approach to looking at assertions in cash, but I hope you find that useful.